Welcome to the Deep Dive, where we crack open your stack of sources and pull out the absolute must-knows.
Glad to be here.
Today, we're diving headfirst into a topic that's really got Wall Street talking. The recent plunge in HIMS and HERS health stock. Ticker.
No, that's HIMS for those tracking.
Right. You sent us a fascinating collection of articles and reports, and our mission today is to unpack exactly what happened, why it matters, and what the future might hold for this telehealth giant. But maybe more than that, we're asking, is this a moment of, crisis for HIMS and HERS, or is it a strategic pivot?
That's a great way to frame it, because what we're seeing here is, yes, a Q2 2025 earnings report that missed expectations, a pretty significant stock drop, and even a class action lawsuit popping up.
Yeah.
But if you connect this to the bigger picture, it's also a really compelling story. It's about strategic transformation, adapting to new healthcare trends, and frankly, the kind of volatility you expect with fast-growing, disruptive companies.
Exactly. So if you've been wondering what's really going on with HIMS and HERS beyond just the headlines, you've definitely come to the right place. Okay, let's unpack this. Let's start with the immediate shockwaves, the stuff grabbing the headlines. HIMS and HERS stock plummeted.
It really did.
Our sources show it dropped over 12%. Specifically, its closing price on August 5th, 2025 was $55.46. That's down almost $8, $7.89.
Ouch.
Yeah, and you might have even seen it swinging wildly in extended trading, too. A brief recovery, then dropping back. The market was clearly reacting strongly to something.
Well, what's fascinating here, and probably the main trigger, is that the drop came right after their Q2 2025 earnings report.
Okay.
Now, while they actually did beat on earnings per share, EPS, they reported 17 cents adjusted versus the 15 cents analysts expected, so a beat there.
Which sounds good.
It does sound good. But they missed on revenue. They brought in $544.8 million against an expectation of $552 million.
So not a huge miss in absolute terms, maybe, but the reaction was severe.
Exactly. And this raises that important question. Why such a strong market reaction to what seems like a relatively small revenue miss?
Right.
Well, for growth stocks like HIMS and HERS, which are often priced, for future potential rather than just current profits, any deviation from that hypergrowth trajectory can trigger a really disproportionate sell-off.
Okay, that makes sense.
Investors are looking for flawless execution, really. And even a small miss like this suggests that maybe growth is decelerating faster than they thought, forcing a reevaluation of that ambitious future they'd priced in.
That really kind of underscores the market's intense expectations for these kinds of companies. And speaking of financial flags, our sources highlight another key detail. Probably contributed to that reaction, too.
Go on.
Despite revenue surging an impressive 73% year-over-year, that's up from $315.6 million in Q2 last year, and profits tripling to $42.5 million.
Which, again, sounds great on paper.
Totally. But the company reported negative free cash flow for the first half of 2025. They spent over $100 million on capital expenditures, which actually outpaced their operating cash flow of $90 million. What does that mean for investors looking at those numbers?
Yeah, that negative free cash flow is a big red flag for many, even with that strong top-line growth. It basically indicates that while the company is profitable on paper and growing revenue like crazy, it's burning cash to fund its operations and that aggressive expansion right now.
Burning cash.
Right. And for a company that isn't paying a dividend, cash flow is often seen as, a critical measure of its ability to self-fund its growth.
So if they keep spending more than they make from operations,
it can make investors nervous, yeah.
Yeah.
Because it implies they might need future external funding, selling more stock, maybe, which dilutes existing shareholders, or they might have to slow down growth if they can't start generating more cash internally.
So effectively, they're burning cash to fuel that impressive growth. Is that riskier than other telehealth players, or is this kind of standard for the sector right now, with all the investment needed?
It's definitely a balancing act common in high-growth tech and telehealth, but the level of cash burn relative to operating cash flow here is what likely raised eyebrows.
Okay. And then how does that financial picture intersect with something as serious as a class action lawsuit? Because, like you mentioned, as if the stock drop and revenue miss weren't enough, HIMS and HERS is also facing a securities fraud class action lawsuit.
You're absolutely right to connect those dots. Financial health or perceived weaknesses and legal challenges often feed into each other in the market's perception of risk.
How so?
Well, this lawsuit, it was filed in the United States District Court for the Northern District of California by Bernstein Liebhard LLP. It alleges misrepresentations concerning the company's promotion and selling of Wegovy. That's a
Hmm.
specific GLP-1 drug.
Wegovy.
And it specifically targets investors who bought shares between April 29th, 2025 and June 22nd, 2025. Important note for any affected shareholders listening. The lead plaintiff deadline is coming up fast, August 25th, 2025.
Good to know. So the lawsuit adds another layer of uncertainty.
It really does. Actions like this can significantly impact investor confidence, sure, but they also divert valuable management time and resources away from running the actual business, so it can create a sort of double whammy when combined with those financial concerns we just talked about.
So it's not just about the hard numbers. It's also about the story, the narrative, and the perceived risks, especially when these legal challenges come into play.
Exactly. These kinds of lawsuits can cast a long shadow, definitely, even if they're ultimately resolved in the company's favor down the road.
But for Hims and Hers, the legal pressure wasn't the only thing going on, was it? There was also this major strategic shift underway that feels crucial here.
Absolutely crucial.
Our sources reveal that a lot of Hims and Hers' recent growth, especially back in late 2024 and early 2025, was really fueled by those GLP-1 weight loss drugs we mentioned, like
Yeah.
Wegovy.
They were a huge driver, yeah.
But then, in Q2 2025, they made a big change. They stopped compounding commercially available GLP-1 options. Now, for listeners maybe not familiar, compounding is basically when a pharmacy custom mixes drug ingredients, right? Often to create a version that isn't commercially available or maybe a different dosage.
That's a good summary. And that whole practice, especially with GLP-1s, has been under intense legal scrutiny from the big pharma companies like Novo Nordisk. They've accused some pharmacies and telehealth companies of illegal, even unsafe compounding.
So stopping that sounds like a really big deal, both for sales and for managing that legal risk.
Indeed, it was a pivotal move, no question. Making that decision certainly eased some of those significant legal risks tied to compounding, especially given those accusations you mentioned. But it also directly impacted sales because, as you said, these GLP-1s were a major growth engine for them. What's fascinating here, though, is that Hims and Hers isn't just, sitting back and reacting passively to these challenges.
They're making a move.
They're making a bold, proactive pivot. They're transitioning towards what they're actually describing as a Costco-like membership healthcare platform.
Costco-like.
Yeah.
Interesting analogy.
Isn't it? It involves expanding significantly into new areas, particularly hormone health, testosterone, estrogen, menopause treatments. It's a clear strategic shift away from being so heavily reliant on that one, albeit very popular, class of drugs.
A Costco-like model. So does that mean moving towards like a subscription-first approach?
Yeah.
Where the membership itself is the key profit driver and the services inside become more accessible, almost like healthcare as a service?
Precisely. That's the core idea. It's a fundamental shift away from a purely transactional model, where maybe they profit heavily on each individual prescription filled. Instead, they move to a subscription-based, more preventative health approach. Their main profitability would then shift to that recurring membership fee. And that actually incentivizes them to offer services and products within the membership at a lower, more accessible price point.
Like Costco does with its Kirkland brand stuff.
Kind of, yeah. It's not just about treating immediate issues anymore. It's about building these long-term customer relationships and getting stable, predictable revenue from memberships. It's almost like a software as a service or SaaS model, but for healthcare.
That's a big change. And maybe necessary. You mentioned GLP-1s were a huge driver.
Well, yeah, and the sources indicate that the core business, if you exclude those GLP-1s, was essentially flat this quarter. And subscriber additions, while up nicely year over year, saw only a small increase compared to the previous quarter.
So that really underscores the urgency for this pivot to work.
It really does.
Yeah.
They need a new engine for growth and stability.
Okay, and to make this ambitious shift happen, they've brought in some serious talent, according to our sources. We're talking a chief of operations from Amazon,
Right.
a chief technology officer from Cruise, which is interesting,
Very.
and even the person who helped build Robinhood's successful membership product to lead their own membership efforts. How do these specific hires support that Costco-like vision?
Well, these leadership changes seem pretty foundational to that long-term vision. An ops chief from Amazon, you figure they're focused on streamlining that efficient supply chain and delivery, which is absolutely key to their direct-to-consumer model, and scaling that Costco-like convenience factor.
Makes sense. What about the Cruise CTO? That seems like an outlier.
It does sound unusual, doesn't it? But the CEO apparently explained it by drawing on expertise from an industry autonomous vehicles where zero accidents are paramount. The idea is translating that critical need for precision and safety directly into medicine and building really robust, trustworthy digital health platforms.
Okay, I can see the parallel there. Safety and trust are huge in healthcare.
Absolutely. And bringing in someone who built Robinhood's successful membership product, that clearly signals just how serious they are about scaling that subscription model effectively.
So they're really staffing up for this transformation.
They are. They're trying to build a platform that goes beyond just prescriptions. Think integrating data from wearables, providing personalized solutions that might include meal plans or exercise guidance alongside medication. The long-term vision seems clear to be this comprehensive platform covering most of your everyday health needs, focusing on preventing issues, not just treating them after the fact.
Okay, so with all these pieces moving, the financial hits, the lawsuit, this really dramatic strategic shift, the new hires, what are the Wall Street analysts saying about HIMS and HERS right now? How are they viewing this incredibly complex situation?
Well, the consensus rating, looking across 13 Wall Street analysts, is actually reduce.
Reduce, not hold, but reduce.
Yeah, it's leaning negative. That breaks down into 3 sell rating, 8 hold, and only 2 buy ratings. So caution is definitely the prevailing sentiment.
And what about price targets? Where do they see the stock going?
Their average price target is $39.83. Now compare that to the recent price we mentioned of around $55.46. That represents a forecasted downside of over 28%.
Wow, over 28% downside predicted.
Yeah. Now, there's a range, of course. Some analysts see a high of $68, so there are still some optimists. But the lowest target is way down at 26 cents.
That's a huge spread, $26 to $68.
It really is. And that stark contrast in opinions truly reflects how divided the market is on HIMS and HERS future right now. There's just no clear agreement.
And valuation plays into that. Is the stock seen as expensive?
Very much so. The company's current valuation trading at about 70 times its trailing earnings and, get this, 103 times its free cash flow.
Whoa.
Yeah, that's seen as incredibly pricey. I mean, to put that in perspective, those are multiples typically reserved for companies projected to grow much, much faster, especially when analysts are only projecting profit growth of, say, 13% this year and maybe 57% next year.
So the valuation seems way ahead of the projected near-term growth.
It suggests the market is baking in an enormous amount of future success from this pivot, success that just isn't visible yet in the numbers.
So it really is a classic show me story then.
Yeah.
The market is basically saying, okay, great vision, great hires, now prove it.
That's exactly right. They want to see tangible evidence that this new direction, this Costco model, will actually lead to sustained, profitable growth before they're willing to award it that kind of high valuation again, especially given the immediate challenges.
And it's crucial to remember, they're not doing this in a vacuum. HIMS and HERS operates in a really crowded market, doesn't it?
Oh, absolutely.
So who are their main rivals, and how does HIMS and HERS plan to actually stand out amidst all that intense competition, especially as they make this big pivot?
Yeah, the telehealth landscape is indeed highly competitive. Lots of players vying for market share. You've got direct competitors like Row, which focuses heavily on men's health, particularly ED and hair loss. They generated around $600 million back in 2023.
Okay, sizable.
Then there's NURX, strong in women's health, things like birth control, STI testing, smaller, about $100 million in 2023 revenue. Keeps is another direct one, solely focused on men's hair loss, maybe around $150 million estimated for 2024.
So specialized players.
Right. And then you have the broader telehealth platforms like Teladoc Health, huge player, projected revenue of $2.6 billion in 2024. They offer a much wider range of medical services, so maybe more indirect competition, but still competition.
And the elephant in the room.
And of course, you can't ignore Amazon's acquisition of One Medical. That brings a very well-capitalized player with massive reach right into the healthcare delivery space. That's a big consideration for everyone in this market.
Definitely. So given that intense competition, what are HIMS and HERS' unique strengths, according to our sources? What's their edge that could allow them to maintain or even expand their position, especially with this new model?
Well, their competitive edge seems to lie in several key areas. First, they have built a pretty strong brand and a direct-to-consumer model that seems to foster loyalty. They've done a good job, many would say, at destigmatizing sensitive health issues.
That's true. Their marketing is quite distinct.
Right. And making care convenient and discreet aligns perfectly with the membership model. Second, they have a user-friendly digital platform and, as we discussed with the Amazon hire, a focus on an efficient supply chain. That enables timely, discreet delivery right to you.
Convenience is key.
Absolutely. What's more, they leverage data for personalized treatment plans that can lead to better outcomes and, importantly, for a membership model, higher customer satisfaction and retention.
Makes sense. Keep people happy, keep them subscribed.
Exactly. And finally, they do benefit from economies of scale, particularly in marketing and customer acquisition, compared to smaller, more niche rivals. They can reach a broad audience perhaps more efficiently.
So bundling convenience, privacy, personalization.
That ability to deliver all that directly to consumers, yeah, that's a major differentiator in a market that's increasingly demanding user-centric health solutions. And it provides a pretty strong foundation, you'd think, for that Costco-like ambition they have.
Okay, so let's try to wrap this up. What does this all mean for you, the curious learner, trying to make sense of this whole hims and hers deep dive?
Yeah, where do we land?
Well, we've seen a company facing some pretty immediate headwinds, right? The stock price hit, the earnings miss on revenue, that pending lawsuit tied to its past GLP-1 strategy. Clear challenges.
Definitely short-term pressures.
Yet beneath that surface, there's also this clear, really ambitious long-term vision emerging. Becoming a comprehensive, membership-based healthcare platform, expanding into new areas like hormone health, and really recruiting top-tier talent to try and make it happen. It's a company in flux, clearly navigating significant issues while also trying to fundamentally redefine itself.
Exactly. And the market, as we saw with the analyst ratings, remains sharply divided. It really reflects that tension, that pull between the short-term financial pressures and this bold, maybe risky, long-term strategic transformation.
So the big question is,
I think the big question is this. In this rapidly evolving digital health landscape where convenience and personalization are absolutely paramount, will Hims and Hers' big pivot to this preventative membership-based model be enough? Enough to outpace all that competition we talked about and ultimately justify that still high valuation?
right,
Or will the short-term struggles, the cash burn, the legal overhang, and just the inherent difficulty of pulling off such a profound strategic shift,
yeah,
will that lead to more volatility ahead? It's a really compelling case study, isn't it, of disruption, adaptation, and market reaction in the healthcare sector. Shows how fast sentiment can swing.
indeed. Definitely something to mull over as you consider the broader implications of where telehealth and consumer-driven healthcare might be headed. Thanks for joining us for this deep dive into hims and hers.
Thanks for having me.